Okay, let's dive right in. If you've been keeping an eye on the housing market, you have definitely seen the fantastic news. After what feels like forever, mortgage rates are finally coming down. But the reason why they're dropping, well, it's not at all what you'd think. And that right there is the big mystery we're going to crack today. On the one hand, you've got falling rates, which is amazing news if you're looking to buy a house. But on the other hand, all the usual signs in the economy are screaming that rates should actually be going up. So what is going on? What's the secret? And we are not talking about some tiny little dip here. The national average mortgage rate just dropped back below that huge psychological barrier of 6%. It hit 5.99%. That's a multi-year low. And if you've been sitting on the sidelines waiting, you know this is a massive deal.
So let's get into it and start unpacking this puzzle. We're going to start with the signals in the market that just don't seem to make any sense. It's a real head-scratcher at first, I'll admit, but once you see this one key piece of information, everything is going to snap right into focus.
Okay, so here's how things are supposed to work, in a normal world. Mortgage rates pretty much always follow the 10-year Treasury yield. They're like dance partners. When the yield zigs, mortgage rates zig. When it goes down, rates follow. For decades, this has been the most solid rule in the book. But lately, that rule has been completely shattered.
And this is where it gets just plain weird. The whole script has been flipped. Check this out. Back in 2024, the 10-year yield was down at 3.62%, but mortgage rates were stuck above 6%. Now, flash forward to today, the yield is actually higher, it's 4.03%, and yet somehow mortgage rates have fallen below 6. I mean, how does that even work? It makes zero sense, right?
So yeah, this is the big question. How on earth can the main thing that drives mortgage rates be pointing one way, while the rates themselves are sprinting in the opposite direction? There is clearly something else going on here, a missing piece of the puzzle.
And it turns out there is. There's a powerful and honestly, a pretty overlooked factor that has just swooped in and completely changed the game. This is the unsung hero of our story. And that hero has a name, the mortgage spread. It's actually pretty simple. It's just the gap between that 10-year Treasury yield and the mortgage rate you and I actually pay. You can think of it like the lender's markup. It's the extra cushion they add on to cover their risk and, of course, to make a profit. This spread, this is the secret variable that explains everything.
Now, in a healthy, predictable market, that spread likes to live in a really tight little range, usually somewhere between 1.6 and 1.8%. This is our baseline. It's the all-is-well signal that tells us lenders feel confident and the market is working like it should. Go ahead and burn that range into your brain. It is absolutely key.
Okay, so keeping that normal range in mind, let's take a look at what's actually been going on. You're about to see just how much of a superhero this spread has been for homebuyers.
Whoa, just look at this number. Back in 2023, the spread exploded to a staggering 3.11%. That's just crazy. It was a sign of pure panic. Lenders were so worried about the economy and inflation that they were tacking on this huge risk premium to every loan. And that, right there, is what kept mortgage rates sky high.
And now, fast forward to today, that crazy high spread has come crashing all the way back down to 1.94%. Now, we're not quite in that perfect sweet spot of 1.6 to 1.8% yet, but wow, we are getting incredibly close. This massive compression of the spread is the single reason mortgage rates have come down. It's all about lender confidence returning to the market.
Just let that sink in for a second. This quote really puts it all into perspective. If that spread hadn't calmed down and come back towards normal, we would be staring at mortgage rates well above 7% right now. That is the kind of massive impact we're talking about.
So here it is, the whole story laid out in one simple chart. The puzzle is officially solved. Back in 2023 and 2024, it wasn't really the Treasury yield causing all the pain, it was that enormous, historically high spread. But today, even with a higher yield, it's that much healthier, near-normal spread that's finally giving homebuyers some breathing room.
All right, so puzzle solved. That's great. But what does a healthier mortgage spread really mean for you, for the average person who might be thinking about buying a home? Let's break down the big takeaways.
What we're really looking at here are the building blocks of a much healthier, more stable housing market. See, when spreads return to normal, it's not just about lower rates. It signals a lot less chaos and volatility. You combine that with more houses finally coming onto the market and price growth starting to chill out, and suddenly things are looking better for buyers than they have in a very, very long time. But hold on, the story doesn't quite end with the mortgage spread. To get the full picture of what's coming next, you have to look at what the Federal Reserve is watching. And right now, their focus is starting to shift. For the last couple of years, it's been all about inflation. But now, it's the cooling job market that's really catching their eye. And that might be the thing that pushes them to cut rates even more.
And that really leaves us with one final thought to chew on. We've cracked the code on the mortgage spread, and it's brought some much-needed relief. But as we look to the future, the next big clue, the one that will tell us where the housing market is really headed, it might have nothing to do with spreads at all. It might be all about the job market.